You know how I told you to properly analyze the stock market? You need to look at the interconnected relationships of not only the stock market, but the treasury market, commodity, yields, the economy. I figured to increase that understanding, why not bring in a real world situation? Here's what I'm looking at the Iran conflict. So if I was on finance media, like CNBC, Yahoo Finance, Fox Business, this is what I would say. It's a domino effect. Oil increased, inflation expectations increased, which caused Fed easing bets to collapse. That caused yields to rise, the dollar to strengthen, gold to fall, and equity multiples to compress. That's what's happening in the market right now. Did that make sense? No. This is pre-conflict rates and prices as of February 26th. This is post-conflict rates and prices as of April 1st. No, this is not an April Fool's joke. WTI increased by 53%, so oil has completely surged. As a result, the University of Michigan does surveys called inflation expectations, and we're looking at the short-run inflation expectations. They were at 3.4%. They increased by 40 basis points, which is another 0.4% to 3.8%. So short-run inflation expectations increased. And the market was pricing in 2 Fed cuts, and now they're only pricing in 1. So Fed easing bets collapsed. Let's break this down further. When the price of oil increases, the worry is that that's going to cause inflation pressure. But it's not just actual inflation, it's expected inflation. If you see the gas prices starting to go up, you as a consumer are going to feel it. The Fed has a dual mandate, which is maximum employment and price stability. If those short-term inflation expectations rise, the Fed is less likely to cut. So yields rise in response. The 10-year yield went from 4.01%, increased 31 basis points to 4.32. The 2-year 3.44 increased 35 basis points to 3.79. So yields increased. There is an important takeaway here. Short-run inflation expectations increased. The 2-year increased more than the 10-year. So you see it reflected in the bond market. The US dollar strengthened 1.9%. There was a sell-off in gold. Pre-conflict, the US dollar was weakening and gold was rallying quite a bit. This is completely unwound right now. This is not acting as an inflation hedge. And equities fell 4.83%, which really isn't that bad. Now, I talked about multiple compression. A multiple is the price that investors are willing to pay for a dollar of earnings. So multiple compression means that multiple has gone down in value. You don't need to know the details, but just stay with me here, okay? A multiple is price divided by earnings. Numerator, denominator. The numerator has decreased. The denominator has actually increased. If you were to divide those numbers, that's a smaller number than before. The multiple has compressed, gotten smaller, because analysts have not revised earnings down. Earnings have actually been revised up, very concentrated in technology and energy driven by oil. Duh. Which means earnings season that's coming up in 2 weeks is literally the most important thing ever that you should pay attention to. But let's go over some numbers. So here's what I mean. For the Q1 earnings outlook, as of December 31st, there was an expectation of 12.8% for Q1 earnings growth. So first quarter of the year. That was a multiple of 22 as of December 31st. If we were to look at April 1st, there is an expectation of 13.2% earnings growth. So an increase. And the multiple is now 19.8. That's a compression. Lower price, higher earnings expectation, driven by tech and energy. So what do we do from here? We don't want multiple compression to turn into an earnings collapse, which means I'm watching earnings season. I want to make sure that earnings are consistently being beat and we hit that growth target of 13.2%. If we do not, and analysts start reducing earnings expectations, then that is bad. Earnings is matching price. That's the immediate term. And if we want to look at the broader picture, every ounce of this, we want to see reverse, but it doesn't have to happen all at once. So the big thing to pay attention to is inflation expectations and yields, specifically the 2-year note. And then we start looking at the relationships. If oil is increasing, but equity markets aren't doing as much, then perhaps they're looking through that. But then I would ask myself, okay, what is the bond market telling us? If the 2-year note stops increasing and starts reversing, and oil is still increasing, or at least stabilizing, that's going to tell you that they're looking through this shock, or they think that shock is already priced in, which means we move our focus to earnings. In all reality, all we're trying to do is understand how these changes impact earnings of the equity market, if you're an equity investor. Side note, if you find this very, very helpful, I have a little secret. I've been working on a software program for a year with some very brilliant minds, and it will tell you this: real data and education. That's all I'm going to give you. Like, it is a work of art. It made me cry. It's so beautiful. It's so great. If you want to access it though, I did put a link in my bio. You can put in your email address. It is not released yet. Comment your questions and follow along to understand how the stock market really works in super detailed, crazy way. Thanks for watching these 7 to 10 minute videos. It means a lot to me. Also, side note, isn't my dress so cute? Word on Yahoo Finance today.